right, so today is, what is today? Tuesday?
Tuesday.
It's flying by. Today's Tuesday, 6 o'clock. It's time for office hours, Q&A. This is where we answer questions that have come in from clients, from people just asking questions. We had a funny one. So one of our team members today, Mark, a client or a member of our Navigators group had written in and said, hey, are we going to get access to your upcoming course on the 74 days course? So for those of you who don't know, I'm putting together a course that is really targeted towards people who are new to business. And it's basically all the things that we do for our clients, but we can't afford to do for you unless you're making a certain level. But you can follow along, you can do all the things, you can save all the money so that your first, whatever, 50 grand, 100 grand is really advantaged in taxes. And the 74 days comes from the fact, actually, we'll get into 74 days later, where that number comes from. But I'm putting together this class. And so this guy writes in to Mark, or he put it on the forum, can't remember which now. And he says, hey, are we going to get access to this? And I said, yes, Navigators get everything. They get all the stuff except for actual client work, because that's obviously custom labor that we have to do, which is the whole issue with the tax world, is that everything is customized and we have to do lots of work to make those things happen. But everything else, they get all the letters, all the templates, all the tools. And I've actually found, yesterday, I found a new tool to help me create more tools, which is like because I have templates that are in Google Worksheets at the moment. But I found a way to turn them into things that I could put into a web page. So there'll be a lot more of those coming through. But anyway, so yeah, Navigators get everything. Explorers, which is our free group, they'll have the opportunity to purchase the course, absolutely. By the way, if you're going to buy anything, you might as well just become a Navigator. It's a way better deal because you get just everything. And it's usually the same price. That's the incentive. But then Mark asks, I think he's one of your competitors. Is it still okay to give him the stuff? I was like, yeah, it's fine.
That's so funny.
Yeah, because here's the dirty little secret, especially with our competitors, is that they're just not going to do the work. Yeah, we pay tens of thousands of dollars a year to keep up to date on our education and the evolving trends in the tax world. But other people can buy the same memberships and all that kind of stuff that we're in at on the professional level, and they can learn the same things and get the same offers for the latest updates and the latest tax saving vehicles and all that kind of stuff. They could do all that, sure, but they're not going to. So I'm not concerned about it. And besides, I looked up the IRS statistics last week, the week before I sent you that list. And there's, was it like 25 Schedule C businesses or something like that filed last, or 2021 was the last number we had stats for.
Yep.
And it's just, okay, that's 25 million people that need help. And as much as I would like to help all 25 million people, it just physically can't happen. So there's enough out there for everybody to really help people who are shooting themselves in the foot tax-wise. So there's plenty for everybody. If you're a competitor and you want to join our group and get all my info, that's fine. I won't be mad at you. If you serve your clients better, that works for me. All right. In fact, well, just to toot our own horn a little bit. In fact, Serena, get the recording from our meeting today with the call we were all on, and clip out that, because what the client was saying at the end is, I was with these guys before, up with another accounting firm, and it was just, I gave her the information, and she just said, here's how much you owe. And totally different than when he's with us with TaxSherpa, because we're actively saving him money each and every year. And this is his second year with us. And this year we're going to save him 80 grand, something like that.
Yep.
Craziness. Anyway, let's see. Let's dive in. We got a couple people watching on the YouTube streams. All right. So yeah, this is Office Hours Q&A. That was all preamble. Who are we? Who am I? Make sure that the screen is working here. Okay. So this is me. I'm Neal. I'm the founder, chief tax strategist here at TaxSherpa. I realized very early on that the corporate world was not for me. And so I went on my own entrepreneurial journey, trying this and trying that. And in 2007, I started getting nasty letters from the IRS saying I owed them over $1.3 million. So that began my tax journey. And like most people, I ignored the problem for a long time, and it took about 2 years for them to start garnishing my wages. And then I started actually fixing my problem and got into the tax returns. Over the last 15 years, worked on over 50,000 tax returns, billions of dollars worth of client earnings, and we save clients millions of dollars every year. That's what we do. And the mission is to help what I call my tribe. And my tribe is the people who either can't or won't get a job. Your independent contractors, your solopreneurs, your small business owners. If you are unemployable, we're here to make that as profitable as possible by keeping as much money in your pocket. And obviously, we can help people who have day jobs as well. But the real power, especially since 2017, when there's the Tax and Jobs Act was passed, the most powerful elements when it comes to the tax world are all on the business side. So if a day job, you at least want a side business because we can still apply the same techniques. They're not as powerful when you have the day job, but you can still apply a lot of the same things and get significant dollars back in your pocket. That's who I am. That's what TaxSherpa was founded to do. And yeah, so why is the screen not advancing? Oh, there it goes. Oh, wow. So this is one of my favorite quotes. Quality of our questions determines the quality of our life. Tony Robbins. So my question is, what is the actual problem with overpaying on taxes? Because you can. It's optional, to be perfectly honest. You are not obligated to arrange things in a way to maximize your taxes. There was a famous court case back in I forget the year, I want to say the 1930s or 40s, where it said the opposite, that a taxpayer is perfectly within his or her rights to minimize their tax burden as much as possible. But the reverse is true as well. You're not obligated to. You can pay more if you want. If you really want, you can actually make donations to the U.S. Treasury. And last time I looked, there was about $113,000 for the entire year were donated for that purpose. But you can do it. But what's the problem with that? And the real problem is that what is my going on my slides? Okay, there's just a lag. The real problem is that you're wasting 20% of your life, and that 20% is an average number that we see. So if you go to work and you do whatever it is you do, and then you earn money and you come home, and at the end of the year you take the money from that day and you ship it off to the government, who did you actually work for that day? That's the question. My answer would be not you, not your family, not your community, not anything worth giving money to. That's how I feel about it. And so if we take you from a 30% rate to a 10% rate or a 35 to a 15, whatever it is, just broad averages, we often see 20% reductions compared to your income. So when you translate that into the year, that's 74 days of your life that you get back each and every year when you optimize your tax situation as much as possible. And so that's time that you could do whatever you like, right? Because you're not handing that money over to the government, you're keeping it in your own pocket. You can take that time and that money, reinvest it in your business. You can spend more time with your kids. You can go on vacation. I don't even care if you go to Vegas and put it all on black. You can put it on red too. Either way, that's still a better use of the money than handing it over to the government, as far as I'm concerned. So that's the problem, is that those days of your lives are being wasted away. And the older I get, the more important time becomes to me. So that's what really strikes me. Because the dollars are great. Don't get me wrong. We're saving a client today, whatever it was, $80,000 this year.
Yeah.
That's fantastic. However, more important than that is all the time that those dollars represent. At least that's how I feel about it. You might feel differently. I don't know.
I feel the same.
You feel the same. All right. So we got 2 for 2. All right. So this is Q&A, so we will get to questions here, but I have all the answers for all the questions that you want. And if my slide advances, there we go. The answer to all tax questions is, you know what it is.
It depends.
It depends. Yes. And I know people get annoyed with like lawyers and accountants and things that say things like this, but it really is true. It really depends. It depends on facts and circumstances. And this is what people don't explain, is that what is true for one person is not necessarily true for another person. So even though the same event happened, let's say $100 got put into your bank account, that does not mean that you owe tax on it. And it might mean that somebody else would owe tax on that same event. It depends on what's going on. It depends on the facts and circumstances surrounding the event itself. And there's a couple fun examples of this, but I will harp on the one that I harp on a lot, which is the going out to dinner one. You go out to dinner with your friends, colleagues, whatever, and you instead of trying to mess with the split bill and everything, you put it on your credit card, and then everybody else sends you a Venmo or a Zelle or whatever. Now, that money coming to you it's money, right? Do you owe tax on it? That's question number 1. And the answer is, Serena, what do you think the answer is?
Yes.
You would owe taxes on it.
Mm-hmm.
I'm going to say no.
No. Okay.
So in that case, it's a reimbursement. So the problem, though, is that there's no way to determine that from the transaction itself. You have to know what's going on around the event. So, like when I pay my kids' music instructors on, what do we pay them on? Venmo, then that is revenue for ordinary income type revenue per drum teacher. When I pay my lawn guys, also on Venmo, that's ordinary income for them. But if I go out to dinner and I shell out money and then my friend pays me back, that is not income. That's reimbursement. The same money transfers happen, but different facts, different circumstances, different tax treatment. And this is true for all things in the tax world. It depends on the facts and circumstances. One of the things that we do on this stream when we go through questions and then I answer them, sometimes the facts and circumstances are fairly straightforward. And sometimes I have to take 30 minutes to explain and answer because so it might be this, or it might be that, or it might be the other thing, So with all that, let's go ahead and dive in. What do we have as far as questions?
Alrighty. We have a client that asks, as a small business owner, I'm overwhelmed by quarterly taxes. How can I simplify this approach?
Yep. There are many ways. So I'll tell you the way we do it for 75% of our clients that this applies to. So quarterly taxes are a very strange beast because a quarter to the IRS is not a quarter that anybody else thinks about. So the quarterly payment dates are April 15th, June 15th, September 15th, and January 15th. Now, if you think about that on the calendar, you'll think that does not quite line up. Some of those are 2 months apart, some of them are 4 months apart, some of them are 3 months apart. That's just what they decided because it fit better with the IRS's internal workload, essentially. So most people think quarter one is January through March, and quarter two is April through June, and quarter three is July through September, and quarter four is October, November, December. That's how most people think of quarters, because that divides a year into 4 equal parts. That's a quarter, right? So that introduces problem number one, is that if you are doing quarterly estimates and you're using the IRS payment dates, then you're going to have this weird cycle of 4 months, 2 months, 3 months, 4 months. And it's hard to manage just at all. If you are set up the way most of our clients are set up with an S corporation and they're taking payroll, then the easy way to do it is you calculate each quarter, and calendar quarter, not IRS quarter. You calculate what your projected annual amount needs to be. And that's going to include your payroll and your profits from your business, factoring in all the tax strategies, factoring in like things like qualified business income deduction and all that kind of stuff. So you do all that work. So you run a projection on a tax basis, and then you figure out whatever the tax would be on that, divide that by 4, and you take that withholding from your W-2 payroll that you run for yourself. And the reason to do it that way is because when you pay income tax withholding through a payroll, as opposed to a quarterly estimate, it gets annualized out evenly. So why is this important? The small businesses are volatile. So some years are good, some years are bad. Some quarters are good, some quarters are bad. And what ends up happening is that if you end up with a tax bill at the end that was surprise because Q4 was better than you expected or whatever the reason is, then the IRS has an expectation that you paid in enough estimates on time, and they're and if you don't, they assess you a penalty. So the default assumption is that you're supposed to pay in even payments throughout the year. There is a worksheet on it's Form 2210. There's a worksheet to do uneven income installments. However, the math does not really work. It does not really reflect the volatility inherent in small businesses. But if you have the withholding through W-2, it assumes, even if you did it all in Q4, it assumes internally that those payments were made equally throughout the year. And so it avoids that issue with the underpayment penalty. And that is a great advantage. Also, if you have a W-2 processor, there's lots of them out there. We use QuickBooks a lot. We used to use Gusto, but ADP, Paychecks, there's a million of them out there. When they process all that, they do all the payments for you. You don't have to worry about, did the check go through? Did the IRS lose something? Did the EFTPS get set up correctly? We had one client who was telling us that all of a sudden his EFTPS account stopped working. Just no idea why. Just just doesn't work anymore. By having the payroll company do all that stuff, that offloads that problem, that set of problems from your plate, which is nice. And they take care of all the payroll form filings and everything. That's a whole pain to itself.
Yeah.
So that's one way to deal with the overwhelm. The challenge with that solution is that you have to have up-to-date books. That's the only way it works. And in fact, maybe I'll tell you guys a little bit later about my quick and dirty bookkeeping system that doing a workshop on Thursday. But core for all business decisions has to be your numbers. And if you go on Shark Tank and everything, they ask, what's your cost per acquisition? What's your revenue? What's your this? What's that? What's that? You got to know your numbers. So where most small business people fall down is they don't have their numbers up to date because they don't do their books. Because either they are unable or unwilling to hire a bookkeeper, and if you need bookkeeping services, we can help you with that. Or they're lazy about it. So we have bookkeeping clients where it's, hey, we need your statement from, we're in August, so it would have been July, radio silence. It's, hey, we need your statements. Hey, we need your statements. And it's just people. I understand people get busy and everything, but this is stuff you got to do. This is part of running a business. We had one guy come to us 2 months ago at this point, and he hasn't put anything together since 2019. And it's just, yeah, that's a problem. We got to fix that and make sure everything is, that we have all the information we need in order to make, the best decisions we can. So if you aren't doing your books, then it's impossible to do projections, and it's impossible to simplify your quarterly process. So that's an issue. Another way to do it, which I generally don't recommend, is just doing the quarterly estimates using the IRS estimated payment system. You can do it. You still need projections. There is a safe harbor for what you paid last year. So as long as you pay what you paid last year plus a little more, you're good. But that does not actually solve the problem of this year. So again, small business is volatile. If last year was a high year, and I've run into this trap myself, last year was a high year. And so I set up quarterly payments this year based on last year, and I just set it to auto draft. And then the current year ended up being less than the previous year. So it's like, now I've overpaid, right? Because I was not reflecting the current reality. I was just basing it on the year before. And so then, yeah, you get the money back, you do. But you've given an interest-free loan to the government, which nobody wants to do. Ideally, you don't want to get a refund. That's the perfect scenario. You just want to be exactly even. Now, exact projections are impossible because we don't actually know the future. But that's the goal. We don't want refunds. We don't want to owe. We just want to be right in there. And that number, we want to be as low as legally possible. So that is another solution where you just pay based on last year. But then if this year was higher or this year was lower, you end up with still owing at the end of the year or getting a big refund at the end of the year. And neither one of those is good. I know people like the feeling of a big refund, but it's not what we're going to actually do. Hold on 1 second. I got a kid who is wanting something. All right, I'm back. A kid asking for watching TV. Anywho, all right, so we got Kim. Are you finding more delinquent taxes because of the pandemic, or is this normal? So Kim's in my top woods group. Is this normal? Yeah, it's normal. So people are delinquent all the time. In fact, if you look at the tax gap reports from the gap is fairly consistent. So I don't think there's any particular issue with the pandemic. Now, what the pandemic did do is, for a lot of businesses, there were delays in filing for a lot of stuff. There were delays in filing a lot of stuff, but those were all resolved by this work. That part's fine. And yeah, that's all worked itself out by now. But there's a lot. I would say at any given point in time, there's a solid 10%, 15% maybe that are behind on their filing taxes. We get a lot. We get people's, one guy said he hasn't filed in 4 years. Got another guy who told, another guy that I know told me just out of the blue, was like, oh yeah, I haven't filed since 2018 or 17 or something.
Yeah.
Yeah. And I get it. I myself got behind from 2002 or 3 until they started sending me letters. So it was a good 5, 6, 7 years or something that I was behind. So yeah, I get it. Stuff happens. And the biggest problem with getting delinquent is that after that, you start to get afraid. So if I file something now, that's going to trigger all this other stuff, and it might, depending on what happened. So there, you start to become afraid to file And I can tell you, though, what the IRS wants is compliance. So they want you in the system, filing your forms like a good little taxpayer. Even if you are due refunds, they still want you to file, just to be part of the system. So yeah, that is normal. It's the short answer. All right, Sarah, what else we got?
We have a client that asks they're going to be starting a side business
Okay.
and they are afraid of the 15% self-employment taxes.
Oh, yes.
So they want to know, how do they avoid this, or what some strategies they can use to move that money around?
Yeah, there's a lot of strategies. So just to explain what they're talking about, if you have either a Schedule C business, which is how most are set up, 25 million according to IRS stats, or you have a partnership, the net profit after you calculate your revenue and your expenses and then net profit at the end, whatever that net profit is subject to self-employment tax. And that self-employment tax is the self-employed version of Social Security and Medicare payroll taxes. It adds up to 15.3%, unless you're over $168,000. And then the Social Security gets capped and it's just the Medicare from that point on. So yeah, it's a hefty tax. So the first avenue of attack is to attack the net profit itself. So if you employ tax strategies to reduce your net profit or eliminate your net profit, then it's going to reduce or eliminate your self-employment tax. So that's the best way to deal with it. The next step is to talk about S corporation status. Any corporation, not any corporation, but most corporations and LLCs can elect to be treated as an S corporation for tax purposes. And I actually just recorded a whole module on this for one of the toolkits that I put up in the Navigators group. And there's certain restrictions. You got to have less than 100 people. You can only have individual owners. You can only have one class of ownership. You can't like preferentially treat this owner this way and that owner that way. So there's some restrictions, but by and large, most companies are going to qualify because most companies are just one person, maybe two, maybe a husband and wife. So the great thing about S corporation status is that profits pass through without self-employment tax. So if you make $100,000 from an S corporation, then you can pay income tax the same as any of the other ones, but you are not going to pay self-employment tax. Huge advantage. And because of that advantage, there's a corresponding reasonable compensation pool where you have to pay yourself W-2 for whatever is reasonable to be determined, because that's not defined anywhere. And on the W-2 portion, you do pay payroll tax because it's W-2, just paying regular tax. And there's a lot of strategy, a lot of math that goes into what should that W-2 be and how can we optimize that? How can we use that to maximize our qualified business income deduction? How can we use that to leverage retirement strategies? And all this other stuff goes into it. But that's the basic framework. First, we reduce income as much as possible. And for a side business, usually that's going to be flat out, we eliminate the profit entirely, unless you have a really, really successful side business, which I've seen sometimes. But most side businesses are not making that much. If we can reduce the net income or eliminate it, on a side business, usually we can eliminate it. And that there's no self-employment tax to worry about. If there's still profit, then we start looking at S corp and see, does that make sense? It does require filing separate tax return, which is actually a benefit because it's going to reduce your audit risk compared to Schedule C. But yeah, those are the decisions to start working through. So nobody should be paying self-employment tax at all, as far as I'm concerned. You should either be paying payroll tax, or you should be not paying self-employment tax because it's profit and not self-employment. So that's how I feel about it anyway. And if you're a C corporation, then it's dividends and it's still not self-employment. All right.
All righty. We have another question.
Yep.
Someone wants to know, how do they qualify to act as a real estate professional? What are the qualifications?
Yeah. So there's two different things, and people get these confused. So there's material participation, and then there is real estate professional. So what it comes down to is, can you convert real estate losses from passive to active? Because most real estate on a tax basis is going to run at a loss. And that's because of depreciation. So you buy a single family house, you rent it out, you bought it for, I don't know, prices are crazy now. So $500,000, right? And then hopefully you're cash flow positive, meaning that you have your rental income and you have all of your cash expenses like your mortgage payment and your insurance and the property taxes and the HOA and the utilities and all the stuff that goes along with houses. And then at the end of that, you have money left over. That's your profit. So the IRS, or really Congress, but enforced by the IRS. So the way the rules are written is that, so you bought the thing for $500,000, houses wear out over time. Even though they appreciate, they still wear out. Then you have you're going to have maintenance, and you're going to have all this kind of stuff. So they have defined the lifetime of a house to be 27 and a half years. And for commercial property, it's 39 years, and foreign real estate, it's 40 years, and whatever. They have what they call a depreciable life. And so you get to write off that portion, 1/27.5th of the purchase each year. So it works out to be roughly 4%. So if it's 500,000, then we're talking 20 grand. So you had your cash, you had your cash in, you have your expenses, you have profit left over, and then you have this minus $20,000, which is going to kick you over to negative in most cases. And that's one of the great advantages of real estate, by the way. So the problem with that, though, is that rental real estate, by definition, is passive because you're not doing a whole lot day to day. You might set up the rental agreement, you might look for a new tenant, you might take some phone calls, but it's not a day-to-day activity. It's not active, right? And so because of that, ever since the 86 tax reform, which was Reagan's tax reform, the passive losses are limited. So there's this thing called PAL, passive activity loss limits. And basically, if you make less than $100,000 for the year, your limit is $25,000 of passive. Now, you would think the more you make, the more that limit goes up, and you'd be wrong. Because what happens is, as you make more than $100,000, the passive limit that they allow you shrinks. And once you're above $150,000, it's zero. And whatever losses you have built up will carry forward year over year until either your income is low enough that you can actually use the loss, or until you sell the property, and then you're able to recapture that loss to reduce your capital gain at that point. We had a client that's dealing with that this year. Had suspended losses, sold the place, made $1 million, which was great, and was able to reduce that $1 million by a little bit because of these built-up losses. So that's the problem with passive losses, is that you have this built-in limitation. Now, the way to get around the limitation is to be active, okay? And active can take, for most people, can take 3 different forms. One is that you have a short-term rental rather than a long-term rental. And a short-term rental is defined by the IRS as 7 days or less, or actually, I think it's less than 7 days. Like your Airbnbs and your VRBOs and your vacation rentals and all that kind of stuff. That's all active rental because you're not actually in the rental business. You are in the hospitality business. And so there is daily work to be done, whether it's done by you or done by a management company or whoever. There's activity happening constantly. So it's a business and it's not just a rental. In fact, if you look in the publication, is it 525 maybe? But the one that talks about rentals, it defines that as like a rental over 7 days. So if you have a short-term rental, by definition, you are active, and then those passive limits don't apply. The second way is to be a real estate professional. So real estate professional means that you are a professional in the field of real estate. You spend at least 750 hours during the course of the year on real estate related activities. You spend at least 50% of your time. And it's the second one that trips people up, of your working time on real estate activities. 50 hours a year is roughly 15 hours a week. And most people, not most, but a lot of people can satisfy that. The 50% of the time is where people get tripped up. Because if you have a day job, that's hard to justify. And in order to justify this, you have to keep logs and show that throughout the year, I spent this much time doing these things, and you got to write it. June 7th, I did whatever. I replaced the silverware, whatever it might be. So all that is to say that if you satisfy that test, which is the 2-part test, then all of your real estate becomes active and you don't have to worry about these passive limits. Now, the great thing about real estate professional status is that you can include activities that are not just related to the particular rental we're talking about. So if you are a realtor who works for themselves, you get a 1099, you are probably a real estate professional. If you are in construction and property management, as long as you're working for yourself in the real estate and related fields, and there's a list as far as what qualifies, then that's going to count towards that 750 hours. Now there's the third version though is material participation, and material means that you are engaged enough in the activity of the rental to justify it being active as opposed to passive. So those are lesser than the 750, but they have their own strings. So there's the 100-hour test. There's actually 7 different tests, but the ones that we use most often are the 100-hour test, which is a weird one. So you have to work at least 100 hours on the property during the course of a year, and you have to be the single individual spending the most time. So if say you work 100 hours on this particular rental property, and then some repairs, and it takes 2 weeks, now, or 3 weeks, now you have to wonder, did any of those people spend more than 100 hours and more than me on that? I don't know, it depends, right? So that test gets tricky because you have to be able to attest that you are the single person spending the most time on this property. Then the next test is the 500-hour test, where if you spend 500 hours on the property, then you don't have to worry about other people. Other people can spend more, but your 500 is still enough to be material. And there's a couple other tests. If you qualified for one of these tests in a previous year, and I think it's 5 out of the last 10 years, then you can still be considered active this year, even though you were passive by the other definitions. So it's a couple weird breakouts, but yeah, there are a couple different ways to skin that cat. And again, the purpose of all of those is to be able to capture those losses in the current year rather than having them deferred or limited. And then once you satisfy one of those, and you convert your real estate losses to be active, then we can talk about cost segregation. That's where it becomes really powerful. Because if you have a lot of other income from some other source, then what cost segregation does is it segregates costs, basically. So you buy the house for $500,000, but you didn't really buy a house. You bought a building, you bought a driveway, you bought landscaping, you bought wiring, you bought appliances, you bought cabinetry, you bought all these other things. And all these other things have different depreciable lifetimes. So they're not that 27 and a half years, they're shorter. And you get special bonuses in the early years. So a lot of times we can, when we do one of these studies, then instead of $20,000 in year one, we might get $50,000 in year one of depreciation. So now what was a relatively small deduction against my other income, now that it's active, and now that I've segregated the costs to accelerate that depreciation up to the early years, now I get huge deductions. $50,000, $100,000 is not that uncommon. There was somebody who came to us last week. He had a $113,000 deduction from he had an Airbnb, it was active, and they did cost segregation. That's how they come out. And you have to get a third-party report and all this kind of stuff, but it's not too onerous. And yeah, he was able to save huge dollars from that deduction against his day job income. So definitely worth investigating if you're interested in real estate. And my favorite use of the strategy, and I know I'm going on and on about this, but favorite use of the strategy is that, so like this one client that we had came to us last week. So he got a $113,000 deduction, which basically cut his income in half for that year. And then, so that saved him between state and federal. I don't remember the numbers off the top of my head, but let's say 30%. So let's just 35 grand. Now the question is, what do you do with that 35 grand? If you want to build a real estate empire, take that 35 grand, you buy another property, and you do the whole thing all over again. And then you save another 35 grand. And then you take that and you buy another property. And then, so effectively, the only net cost you had in building out your real estate empire over the years is that first property. Because that first one, the tax savings from it pays for all the other ones. And then the next one pays for the next one, the next one pays for the next one. And before you know it, 10 years goes by, you have 10 properties that are all cash flowing, hopefully if you buy right. And yeah, that'll work. I knew a guy, had a client years ago. He was a waiter at one of the country clubs in South Florida, and he made decent, normal kind of money. And he built out a portfolio of these rental houses, and he did all the management himself, he did all the repairs himself. He was very hands-on. After whatever it was, 8 years, something like that, he's like, yeah, I quit my job, and now I'm just doing real estate, just money from rentals. It's the old-fashioned get rich medium quick strategy. 5-10 years, that'll do the job. So yeah, so real estate professional, 750 hours, 50% of your time, multiple real estate activities qualify. Lesser tests, 500 hours, 100 hours, or the property itself is active by being less than 7 days. All of those allow you to capture current year losses to net against current year income. And one last note on this one, and then I'll get to the question that's in the chat, is that you should only do this if you have a tax liability. Because we see people they saw some seminar somewhere and they get real excited about cost segregation. So I buy real estate, you know. Then they do this cost segregation study. And if you're doing a commercial property, it could be like a $5,000, $10,000 bill to get the study done. If you're doing residential, it's a couple $100. It's much easier. And so they do the cost segregation study. It's great. You didn't need to. It didn't help you any because you didn't know any taxes. So I guess it'll help later on when you do have income. But that's the thing about working with people who know what they're talking about effectively. And a similar kind of thing happens we've seen it many times with the solar credits and the electric vehicle credits. People get suckered in by these sales pitches saying, oh, you get a 30% tax credit, so it's not $20,000, it's $14,000. So, yeah, if you owed enough federal tax in order to absorb that credit. Same thing with electric vehicles. Yeah, there's a $7,500 credit. There is, yes. If you owe $7,500 in taxes, you got to make sure the part is true first. And if you don't, those credits do not roll over. They are just use it or lose it. You can't sell them. You can't do anything. You're stuck with them. Yeah, so that's the real estate professional. I don't know what that took 30 minutes to explain, but sometimes that's what happens. All right, we got a question. Are you planning on doing a live where you analyze a tax return showing tax savings, for example, SP versus S Corp? SP is sole prop. Yeah, I've done that in the past. I don't have a plan for today, but we can do that. Absolutely. In fact, let's do that next week. Sarita, remind me that. Sarita, did you freeze? Oh, there she is.
Yeah, I'm back.
So
sorry about
make a note to remind me that next week we can do a case study where we can show how converting from like a Schedule C to an S corp kind of thing.
Okay.
Yeah, those are always fun.
Yeah, those are fun.
And it will all be anonymous, but I'll use real numbers.
Understood.
Yeah, that's real estate.
Question for you, Neal. Can you explain how the 1031 exchange works and what's the benefit for it?
Yeah, so the benefit is that you get to not pay taxes. That's the benefit. 31 is what's called a kind exchange. And it used to be more widely applied, but now it's just for real estate ever since the Trump Tax Cut and Jobs Act. What it is, you sell a property. You don't need the money yourself. You want to keep that money invested in real estate. You sell the property, the money doesn't go to you, it goes to a 1031 intermediary who is a registered person who is qualified to hold the money on your behalf. Then within a certain time frame, I think it's 3 months to identify and 6 months to close, or something like that. Within a certain time frame, you deploy that money into another property. It could be one into multiple, it could be one to one, it could be multiple into one. As long as the money flow is from real estate into real estate, then it's going to qualify. And the benefit of doing that is that they say, okay, you didn't take any money out, therefore you don't owe any tax. Your cost basis from the previous property is going to carry forward into the next property. And that's important to realize. Let's say 10 years ago, you bought a house for $200,000. Now you sell it today, it's $500,000. So you say, okay, I don't want to take the hit on the $300,000 gain, and I don't need the money. I like the rental income. I want to keep it invested in real estate. Okay. So we take the $500,000 from the sale, and we put it down on a mortgage. We buy a $2 million small apartment complex. And okay, great. That's fine. Then you're going to have your year-to-year income, and you're going to have your cash flow and all this kind of stuff. Now the question is, what do you get to depreciate on the new property? And the answer is not much, because your cost basis of $200,000 from way back when is what carries forward into the new property. So you don't get to claim that you bought this for $2 million, because really you're just rolling the same investment over and over again. And so you don't get to step up your depreciable basis each time. Your original basis is going to carry through. So then when you sell the $2 million property, it's not a gain from 500 to 2 million. It's a gain from 200 to 5 million, or 200 to 2 million. So you got to be aware of that. So basically, the tax problem itself grows over time. That's how that section works. And the people who are building a real estate empire, will 1031 and 1031 and 1031 and 1031. And the real plan is you're going to refinance out cash along the way, but you're never going to capture 100% of it. And you're basically locked in to never sell, is how it ends up working out. And then you pass away, and your heirs get a step up in basis. So they don't have to pay tax on it. You didn't have to pay tax on it anywhere along the way. And then everybody's happy except with the government. I will tell you that this is under threat currently. What's her name? Harris. So she has, or her campaign this week has softly endorsed the Biden 2025 tax proposal. Back in March, I think it was, the Biden administration released this budget proposal for 2025, and along with it were a whole bunch of tax changes. They say, we want to spend this much money, and we're going to raise a whole bunch of money by increasing taxes in various ways, and there was 500 pages of explanation. And obviously Biden dropped out, Harris is in, and nobody was really sure, okay, was this still the plan for the Democrats? And this week we were getting the answer that yes, this is still the plan. So one of the things that's in there is that they want to limit the 1031 exchange power, in that they want to limit it to one transaction a year, and they want to limit it to $500,000 of gains. So if you have a $2 million gain, you're still going to pick up the tax on the 1.5. And that's what they want to do. Obviously, this all has to be passed by Congress and all this kind of stuff. So there's many steps between here and there, but that's their plan. And also under threat is the step up in basis. And this is critical to understand. So the step up in basis is that when you inherit something, your cost basis is effectively whatever the value was when you received it in the inheritance. So like the middle class transfer of generational wealth is largely in their houses. So if grandma bought this house in 1952 and it's now worth $500,000, and she passes away and she leaves it to her kids, that's a $500,000 asset that the kids get tax-free. So if that gets eliminated like the Democrat plan wants, then that's going to be a problem. Because if you now owe tax on $500,000 as a recipient, as an heir, most people just have to sell the asset, right? That's the only way to do it. Or you'd have to take out a mortgage and then finance the tax, essentially, which sounds horrible. It's a big issue, and I am hesitant to be all doom and gloom about it, just because it would require an act of Congress in order to get that kind of thing changed, and I don't think those things would survive that process, at least with the Congress being very close to evenly split, Democrats and Republicans. Even if the Democrats win the presidency, I think their chances of getting that kind of tax reform done are limited. But you never really know, right? Politics makes strange bedfellows and all those other expressions that people use. There's probably more of an answer than you might have wanted.
No, it's okay.
All right. We are at the end here. Yeah. If you want to register for that 74 days course, there's a list. You just go to TaxSherpa.com/74 days, 74-days, and you'll get notified when it's available. For Navigator, you get it free, so don't bother. But everybody else, register for that. And that will show you like how to, this is the same steps that we apply to every business. And it's how do we get from zero, like I just have this idea to make money, and I'll take you all the way through to making money, getting it. We don't teach you how to make money. We teach you how to protect the money that you have with entity structuring and tax planning and all those kinds of things to make sure that you keep as much of what as possible. And then once you're making a good chunk, then we can start to talk like real optimization that's customized to your situation rather than just kind of the default that we go through in the 74. So like if you want to save $80,000, we need to talk. That's not something we can just work up a template for because it's custom. It's very custom. We got to understand the ins and outs of your situation and see what applies. But yeah, that's all I got for this week. Serena, anything else that you wanted to hit?
Just join our workshop, Navigator group.
Yep.
It's very beneficial. You won't lose.
The other benefit with the Navigator group, and I know I don't have the link up, I think it's just TaxSherpa.com/navigators.
Yeah, I did.
I should probably know. I wrote it right. The other big benefit is get on a weekly call, just a Zoom call. Yeah. It's every Thursdays at 3 o'clock Eastern, and we'll just go over whatever the topic of the week is, and people have questions, and we're able to answer them in a small group where we're all friends, basically. And yeah, there might be some competitors in there. I don't know. I wouldn't be too surprised. All right, that's it for now. And so same time next week, Tuesdays, 6 p.m. Eastern. We stream on YouTube, we stream on LinkedIn. Although I don't know if anybody watches on LinkedIn, to be honest. We were on Facebook until Facebook implemented the new requirement that we need like a certain number of followers in order to do live streams. At some point, we'll focus on the Facebook page and get followers because we don't post on Facebook hardly at all. But yeah, that's it. And save 74 days life as a takeaway. All right, good talk, everybody. We will catch you later.
Alrighty.